Hello everyone, this is Mike Caligari. This video is the first of several in which I describe the financial reporting disclosures of Silicon Valley companies. This particular video discusses some features that we see in income statements. Before viewing the income statements of Silicon Valley companies, however, I'll describe the income statement for a traditional retailer, Home Depot. Once we are familiar with Home Depot's income statement, we will compare it with other companies and note the differences. An income statement reports a company's revenues, expenses, and net income or loss for a particular period. Following SEC requirements, Home Depot presents 3 years of income statement data in its Form 10-K. The multi-year format helps users assess its growth in revenues and expenses across time. To facilitate our analysis, I common size Home Depot's income statement by dividing each income statement item by total operating revenues. This allows us to view each item as a percentage of sales, which helps financial statement users like us to compare income statements across time and between companies of different sizes. Like most retailers, Home Depot's largest expense is its cost of revenues. In the common-sized income statement, gross profit represents the weighted average markup that Home Depot charges its customers. The common-sized income statement indicates that Home Depot's weighted average markup for the year ending in January 2016 was 34.2%. The second section shows only two categories of operating expenses, SG&A and depreciation. These expenses represent the Home Depot's costs of running its stores and managing its business activities during the period. After subtracting these expenses, Home Depot's operating income is 13.3% of sales. The third section indicates that non-operating items for Home Depot are relatively small in amount. Investment income is the interest and dividends earned on its investments in cash and marketable securities, while interest expense is the financing charge incurred by the company on its borrowed funds. Investment income and interest expense are considered non-operating because neither is necessary for operating a business. Companies separate these non-operating items from operating income so that analysts and investors can better compare its operating performance across time and with other firms without the distorting effects of differences in financing strategies. After adding investment income and subtracting interest expense from operating income, Home Depot's pre-tax income is 12.5% of sales. In the fourth section, Home Depot reduces its pre-tax income by its income tax expense, also known as the provision for income taxes, to end up with the bottom line, net income. Home Depot's net income for the year is 7.9% of sales. The first of the three Silicon Valley companies we examine is NVIDIA, a Santa Clara-based GPU and chip manufacturer. To help identify differences between NVIDIA and Home Depot, I present NVIDIA's common-sized income statement alongside that of Home Depot. You should immediately notice several striking differences. Beginning at the top, NVIDIA's gross profit is much higher than Home Depot. While Home Depot differentiates itself from other stores through price and selection, NVIDIA markets its products on performance differentiation, resulting in higher margins. Second, NVIDIA incurs significant R&D expense to improve its current products or develop new products or processes. We'll see that R&D expense is a common feature of most Silicon Valley companies. By contrast, NVIDIA's SG&A expense is significantly less than Home Depot because it does not need to operate the store facilities of a brick-and-mortar retailer. Third, note that NVIDIA does not report depreciation expense on the face of the income statement. This is because NVIDIA, unlike Home Depot, includes its depreciation expense within its cost of revenues, SG&A, and R&D categories. Last, note that its effective tax rate, which is calculated for you at the bottom of the page by dividing the income tax provision by pre-tax income, is about 1/3 of Home Depot's. This tax differential is largely due to Home Depot operating primarily in the US and Canada, while the bulk of NVIDIA's sales are overseas. The next Silicon Valley company we examine is Workday, the cloud-based software vendor headquartered in Pleasanton. Workday was founded in 2005 and went public in 2012. This income statement reflects its performance for the year ended January 31st, 2017. One of the first things you should notice is that Workday incurred a net loss for the year, as its expenses exceeded its revenues. This is quite common for Silicon Valley startups, and successful companies often generate net losses for several years before becoming profitable. As a provider of cloud-based software, Workday's cost of revenues is relatively small and consists primarily of employee-related expenses relating to hosting applications, providing customer support and professional services, costs of data center capacity, and depreciation of computer equipment and software. Like NVIDIA, Workday incurs significant R&D expense to introduce new applications, technologies, features, and functionality. It also incurs significant sales and marketing expenses. As of January 2017, Workday was still in an aggressive growth phase, and its investment in R&D, marketing, and infrastructure is not yet reflected in current period revenues. As a result, Workday reported a significant operating loss for the period. The third Silicon Valley company is Salesforce.com. I include its common-size income statement for the year ended January 31, 2017, which is the first year it reported positive net income. As a provider of cloud-based software, its cost of revenues, like Workday, is relatively small. Also like Workday, it incurs significant costs relating to research and SG&A. Unlike Workday, however, it has reached the point where the scale of its global sales now exceeds its operating expenses, although the operating income margin is still relatively small. On a side note, Salesforce enjoyed a significant income tax benefit that was largely due to the release of a valuation allowance in connection with its acquisition of Demandware. This is an example of an accounting-generated benefit that financial statement users largely ignore when analyzing a company's performance. We'll discuss how one might analyze unusual or non-recurring transactions in a later video. Let's summarize what we've covered. Common sizing the income statement by dividing each item by top-line sales revenue helps users compare revenues and expenses across time and between firms of different sizes. Silicon Valley companies are distinguished by relatively high levels of gross profit, which doesn't always translate to net income. And last, Silicon Valley companies are also distinguished by comparatively high R&D expense, as this is often their primary driver of future growth. Thanks for joining me. I'm looking forward to describing some of the financial reporting practices of these companies with you in future videos.